This is the biggest, most significant jump in fear that I've ever seen.
It is the kind of Monday where you kind of wish you could just stay in bed and you really don't want to open up your account and look at what your stocks are doing today, Thomas. Talk about what is going on in the market. It's a crazy Monday.
It is a crazy Monday. This is kind of an example of how quickly the market can change its mind. I mean, last week things started to change, but even just 2 weeks ago, the VIX was at historic lows. We were in a no fear market. Everything was honky dory. And now it's chicken little and the sky is falling. Let's just get out of the market as fast as you can.
That's definitely what it's looking like today. Let's talk about just how significant of a down we're seeing right now.
Right. So the S&P 500 was down 4% at the low. It's up a little bit right now. But the real move was in the VIX. The VIX is the fear index. That kind of fear index is kind of a misnomer. It really measures the price of options versus the S&P 500. But when the price of options rises, it's used as an indication of fear because people are putting a premium on their options. But the spike in the VIX was about 150%. I've been watching the stock market for over 20 years, and this is the biggest, most significant jump in fear that I've ever seen. And the way that that chart looks, this could be just the beginning. I would expect to see the VIX continue to rise, at least to spike one more time with a big sell-off and possibly set a new all-time high.
150% is a huge jump. And to say this is the biggest of all time is quite something because we just had 2020. We've been through a lot as a country and an economy.
Right.
What's triggering such a huge jump?
So this is the compounding effect of two different news stories. All right. The first one was the CPI report that came out a few weeks ago. Inflation was cooling, has the FOMC on track to cut interest rates, which should signal an economic pivot, easing economic headwinds, easier economic times, and that was sector rotation. So the market was already set up to start selling. We've seen some selling over the last few weeks. That was confirmed by the FOMC meeting, where they pretty much said, that a cut is on the table for in September. So then Friday comes around, this past Friday, the non-farm payroll report, the big monthly labor data, it came out weaker than expected. I'm not going to say it was bad data. It was just weaker than expected. And from my perspective, it's still trending in a healthy zone. But over the last couple of months, pace of job growth has slowed. Unemployment is starting to creep higher. Wage growth is slowing. And it's raising fear of recession because the labor market is a lagging indicator. The data is like a month or 2 months old in most cases. So it's hard to know based on what's going on right now based on the labor data. And because FOMC rate cuts tend to take 12 to 24 months to be fully felt in the economy, there's a very big chance that right now the economy is worse than it seems and that it's going to be getting worse over the next month or two. And that means recession. Recession's never a good thing.
Yeah, Thomas, we just had your article out on marketbeat.com on the recession and the possibility of this. I do want to talk a little bit about you've been predicting this a lot of the summer. We've been talking about how hot the market has been all summer long, but you warned us that this pullback could be coming.
Well, right. So the technical setup has been there for quite some time. The market's been rallying for over 2 years. It started with economic normalization post-pandemic that was boosted by inflation and consumer spending, government spending, and then the whole AI craze. So the market was really pushed to really extremely high levels, overran itself, also pricing in the expectation for Fed rate cuts. So when those cuts came, it became a sell the news event for sector rotation, but also set up for a big pullback simply because of the technical outlook. The market's well above its key critical support targets. And now we have this fear event into play, and that's just compounding that entire situation and causing the sell-off to be much deeper than it might ordinarily have been.
Yeah, I know you talked a lot about the fear factor right now, and that's what we're seeing a lot of today in the market. Is this just a knee-jerk reaction, or could this fear lead us even further down in the market?
So I think it is kind of a knee-jerk reaction. I think that the market could continue to sell off because we're looking at some pretty big gains. So the opposite of FOMO, the fear of missing out, would be the fear of being in too long. People are going to try to flee to cash as fast as they can to save their gains. But I think ultimately it's going to be a buying opportunity. The market will correct, but economic conditions are still okay. We're not in a recession now. The FOMC is expected to cut interest rates, and that will signal a pivot. So long as we're able to get past the next couple of months without having a recession, I see the market bottoming before the end of the year, possibly as soon as next month, and then beginning to rebound.
Well, that's not so bad of a long-term outlook, but I feel like there's a lot of opportunity in the short term to have a lot more volatility in the market, Thomas.
Yeah, I think that the market could continue to fall. It's definitely going to be under pressure in the near term, the next couple of weeks. Um, but there is a chance for it to rebound. But just because I think that's going to happen doesn't mean it will. There is this key technical level right around 4,800 for the S&P 500 that if it does not sustain that level, it could just trigger a lot more selling just because the market has fallen down so low. In that situation, the S&P could end up range bound in these low levels that it saw over the last 2 years, which is really a bad thing because as far as the long-term trend goes, the S&P is about 45% above its long-term trend. So ultimately, it could fall another 45% on a technical basis. I don't think that's likely, but it is possible. The more likely scenario, given assuming that the market continues to be under pressure, breaks that key level, is that it will remain range bound for many years. So that that trend line projected into the future, assuming sideways price action from today, it's going to be 10 or 12 years before the market reaches that line. Not saying that's also going to happen, but it's a significant risk that the market could be range bound for quite some time and investors will struggle to see gains on a year-to-year basis.
Well, hopefully you enjoyed your summer while things were at a high and the market was looking good. This is
Right.
not a great outlook for a lot of people heading into the start of the school year and just a fall season for everyone. Let's talk about what to do right now. What should investors be doing? I think that the tendency, at least what I would have, is let's just not look at the market and wait and see what happens right now. Is that a good outlook, or what should investors be doing right now?
Most investors have an advisor that and a plan, and so the best thing is to stick to your plan. It's never a good idea to follow knee-jerk moves because the next thing you know, it's going to knee-jerk the other direction. For investors, it's all about waiting for these dips to buy your favorite stocks at lower prices. The market will recover sooner or later. It's just a question of does it start recovering within the next few weeks, the next few months, or does it take years and years for recovery?
All right, Thomas, we've had a really good discussion about are we in a recession? And you've given lots of good information here. What else do you think investors should know about what's going on in the stock market right now this week?
Right. So back to the idea of sector rotation and the FOMC cutting interest rates. They are expected to cut rates. They may be spurred to cut rates sooner and more aggressively now because this fear of recession is in play. And in that scenario, we should expect the economy to begin rebounding, maybe not this year, but as early as next year. And in the idea of rotation, the next group of stocks that's going to do well will be small caps and mid caps. The Russell 2K, we've done a video on that, performed very well over the last few weeks. So now wait and see what happens, assume the best, waiting for sector rotation to continue, start building a good watch list of your favorite small caps, and be ready to buy them when the signal comes.
How about the opportunity to buy maybe some of those big name stocks like Nvidia or Microsoft right now? If they're down, is this an opportunity to get in on some of those bigger names too?
Right, it is an opportunity in them as well, but they are the leading cause of the correction. They're going to correct the most, and I would absolutely be on the fence with them until there is a clear market bottom.
All right, some good advice today, Thomas. Thanks for having this recession conversation today. It's what everyone's talking about. And of course, we're going to continue to follow it all right here on Market Beat.